Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I look not only at other indexes within the stock market, we also look outside the stock market to try to get some clues as to what may be happening ultimately with the S&P 500. This is being prepared for Monday, July 17th. The first thing that we look at is S&P 500 valuation. Are we considered expensive, fairly valued, or cheap? Well, we have two ways that we look at that. We look back at historical data to see where we're at right now, and then we look forward at projections as to what valuations might be going into the future. The first area is looking back. We call this TTM. That's the trailing 12 months. This goes all the way back to 1980. The red line is a PE ratio of 20, and this is a static number that the market has come up with. When you're at 20 or above, the market is considered to be expensive or overvalued. When you're at 15, that's where we're fairly priced, and when we're at 10 or below, the market is considered to be inexpensive or cheap. The black line is the S&P 500. The closest line is the PE ratio of 20, so on a historical basis, the market is considered to be expensive. But you can see, going back through time, this can last for a long time. So it's nothing that we necessarily use to make day-to-day decisions. We just want to be aware of this as we look at historical charts. We also can look at this in the face of different events that have happened and what the valuations of the market were at that time. We also look at another thing called the Shiller PE ratio, which takes more of an average approach of earnings over time and then compares them with historical prices. Right now, we're getting a reading of 31.4. Well, to give you some context, the median and the mean are between 16 and 17, so we're over double on a historical basis, being more expensive than we have been historically. But the market looks forward, so we look at the forward PE ratios, and as of Friday, the S&P has a PE ratio going forward of 19.4, so we're just under that 20 mark. When we look at the mid caps, we're at 14.1, and the small caps, we're at 13.7. Then another area we look at is growth versus value. Growth is when you want to buy low and sell high. Value are stocks that you might get into when the market's having some difficulties. They might be older companies where you're paid dividends. They've stood the test of time. They tend to weather downturns better than some of the growth stocks. Well, right now, when we look at just the growth index, it still is in an overall downtrend. We also look at the value index, which is showing some improvement, but is still in an overall downtrend. The interesting thing is when we compare the two, we take a ratio, growth versus value on top, showing how growth is outperforming, and then down below, it's value versus growth and how value is underperforming. And the reason why I have both of these and I show lots of different charts when it comes to growth and value is all of these different indexes and ways of looking at this, they're calculated slightly different. So we want to get confirmation among multiple ways that we look at growth versus value. Another thing that we look at is an ETF. Lately, we've just seen a golden cross where growth is now starting to outperform value, where the inverse of that is that value is now underperforming growth. We look at an index where growth is now showing some weakness here, but it's still in an overall uptrend when compared to value. And value is really underperforming growth, and we've seen a recent death cross with this ratio. We also look at growth versus value, looking at some other indexes where growth is now starting to outperform. Then we look at some different ratios with some different studies on here, showing how growth is really improving when compared to value, and value is really starting to underperform growth. And this is more healthy for the overall market. We want to see growth doing well, so that's when the indexes and stocks and different sectors really tend to climb. We also look at the small caps, and we notice that when we compare small cap growth to small cap value, we're still in an uptrend, but lately we've been chopping sideways. If you just look at the index, we were down, and yeah, we've been seeing a bit of a bounce here, but while we were going down, we saw this ratio really going up. Mid caps are also kind of a stronger area of the market right now. The index had been really under pressure earlier in the year. It's starting to bounce back. Well, as the index was going down, growth was really outperforming value. Then we look at S&P growth versus value. It's still in an uptrend. I look at this chart every day in the daily videos that I do, but it's a little bit concerning that we are drifting lower right now. We also keep an eye on inflation. We look at the CRB monthly chart on top where it's still in a downtrend even though it's been ticking back up. We look at a ratio between inflationary areas and deflationary areas in the CRB, and even though it's turning back up, we're still going down overall. But we want to keep an eye on this as commodities have been showing a bit of improvement. We also look at the CRB index itself, where it continues to be in a downtrend, but it has shown some recent strength. Then we look at the Baltic Dry Index. What does it cost to ship products from one place to another? This continues to be in an overall downtrend. Some other markets, we look at aluminum, which is in a downtrend. Corn is in a downtrend. Wheat, downtrend. Fertilizer, ticking back up, but still in a downtrend. Gas, chopping around, but still in an overall downtrend. Diesel prices have also been declining. Natural gas really spiked up, came down, is bouncing back a little bit, but is still in a downtrend. Heating oil, also in a downtrend. Oil, which is camped out around 70 for a while, now it's starting to go back up, but it's still in an overall downtrend. Lumber also is in a downtrend. Copper, we're starting to see a death cross with this. Copper's a little bit different. We call it Dr. Copper for how do things look going forward. When copper's doing well, that tends to mean that the economic future looks more bright. When copper starts to really underperform, that means that looking forward economically, we might see some weakness. We also compare copper to gold, and we take a ratio of that. Where copper has been really underperforming, it's seen some strength lately, but most of that is to do with weakness that we're seeing in gold right now. Then we look at a longer-term version of this same chart. That's the black line, is the copper to gold ratio. We also plot the 2-year yield, which is green, and the 10-year yield, which is red. Usually these have a tendency to go in the same direction, and they have a tendency to not get all that far apart from each other, even though they're on different scales. Right now, we're seeing a pretty wide spread between them, and they're not necessarily following each other. Here's gold, where it is in an uptrend. It saw some weakness, but it's been bouncing back. It's coming back up to its 50-day moving average. Here's silver, also in an overall uptrend. It's been able to break above its 50-period moving average. Then we look at gold on the top and silver, and then we look at the correlation between the two, and it's pretty obvious, but now you can quantify this by looking at a chart by saying, look, the correlation between gold and silver is pretty strong. Now, we did a little bit of a study here where we look at the gold to silver ETF ratio, and in a general sense, when the US dollar is going up, gold outperforms silver. When the US dollar index is going down, which is what it's been doing lately, silver tends to outperform gold, and there's a correlation that's really strong right now between the gold to silver ratio and the US dollar index. Just something to keep in mind. The US dollar finally broke below 100, so it continues to show some weakness, and it is in a downtrend. Typically, as the dollar is falling, that tends to give support to stocks because it makes companies' books look better, and it makes the import-export ratio more in the company's favor. We also keep an eye on the euro, which has been going up against the dollar, where the dollar index has been going down. We also keep an eye on the Japanese yen. Then I have an individual chart for that, where we're still in a downtrend with the Japanese yen to the dollar, but it has been bouncing back lately. The British pound is in a pretty solid uptrend compared to the dollar. Then we look at some different indexes. This is a ratio between the S&P 500 and the CRB index, where the S&P 500 is outperforming. An inverse of that shows the CRB index underperforming. Then we look at this, and I go over this every day too, the equal weight index, where every stock is treated the same in the S&P 500, versus the S&P 500 itself, which is a weighted index. The equal weight index has been showing some improvement, but it's continuing to underperform the S&P 500. The NASDAQ 100 is outperforming the S&P 500. They're both doing well, but the NASDAQ 100 is even doing better. The S&P 100 continues to outperform the rest of the S&P 500, where it saw some weakness, but now it's starting to come back. Small caps continue to really struggle against the S&P 500, and that's a bit of a concern. In a good, solid environment, we want to see the small caps participating as well, and we're just not seeing that. The NASDAQ has been outperforming the S&P 500. Again, both have been doing well, but the NASDAQ's been doing even better. Now we look at the NASDAQ 100 and the NASDAQ, in which both have been doing really well, but the NASDAQ 100 is really outperforming. Then we look at some other stocks. These are the 30 biggest software companies in the US. They are in an uptrend. We look at the mega cap growth, the really, really big companies, and compare it with the equal weight index. It shows that the big companies are still holding most of the market up right now. Mega cap growth. These are the really big companies again by themselves, showing that the ETF is just going up strong. We look at the robotics and AI ETF. That's kind of the rage these days, where it is doing well when we look at it by itself, but when we compare it to tech, it's showing some improvement, but it's not outperforming the tech sector. We look at the S&P 500 and compare it with short-term bonds. This is showing that the S&P 500 is really outperforming bonds. We look at a broad market look at the stock market beyond the S&P 500, and we compare it with further out bonds, also showing that stocks are outperforming bonds. The tech sector is really outperforming bonds. And then we look at the Dow Jones Composite Average, which has been going sideways for quite a while now. Are we going to see some kind of a breakout to the upside? We're waiting to see if that will happen. In the meantime, it's still in an overall uptrend. Low volatility stocks, which held up pretty well in 2022, they're still chopping sideways in 2023. When we compare low volatility stocks to the S&P, though, they are really underperforming. The FANG index, and we're keeping an eye on this because we're going back and testing the all-time high. We have not closed above that yet, but we're getting close to that level. ARK is also making a bit of a comeback. It was up solid this past week and is starting to show some improvement after giving us a recent golden cross. Then we look at Dow theory, and what I've been paying attention to lately are the transports. The S&P 500 and the transports, when they're both moving up together, they support each other and provide a lot of good strength to go higher. We broke out with the transports, but on Thursday and Friday, we did see them down. Here's showing the transports and the Dow, where they're both performing at about the same level right now. Then we look at a ratio between the transports and the S&P. We want this ratio to be going up, even though it has shown some recent weakness. Then we look at the correlation between the S&P and the transports. The S&P has been holding up better, but the transports have been a little bit weaker, so we're seeing this relationship not as strong as it usually is. Then we look at a new way of taking Dow theory and changing it over to more modern things. Instead of using the Dow, we replace it with the S&P. Instead of taking railroad stocks or the transportation index, we replace it with the NASDAQ, and that's tech, where they're both tending to perform very well and confirming each other. Then we look at the S&P 500 and compare it with Europe, Australia, Asia, and the Far East. This is a monthly chart, so it takes longer for this to change. We're above this advancing moving average. That is strong. We're also seeing the PPO on the bottom turning and going higher. That's also positive. Eventually, if we could get above zero, that would make things even more positive. Then we look internationally. China's trying to turn back up after it had been seeing a decline. The same thing with emerging markets. We're still in a downtrend with Europe. We're pretty much flat with Japan. We're trying to turn back up with the S&P, but we're still headed down according to this KST oscillator. Looking at bonds versus stocks, here's the total bond ETF, which has been chopping sideways but is still in an uptrend. World bonds really chopping around a whole lot. We started to go back up, and we are in danger of seeing a death cross here, but with this recent strength, that is helping the overall moving averages. Stocks continue to outperform bonds on a monthly basis, but bonds are really underperforming stocks. We look at high yield bonds, which means junk bonds. They're holding up quite well. If the economy was getting ready to fall apart, we wouldn't really see this going up the way it is. We also look at investment grade bonds. These are more conservative bonds. They've been chopping sideways, but they're still in an uptrend. The Dow Jones Corporate Bond Index also, can we be seeing a breakout here at some point? It's been chopping sideways, but we are still in an overall uptrend. We look at the stock to bond correlation, and right now they're having a real strong tendency to go in the same direction. We look at riskier bonds, which could be junk bonds, more speculative bonds, and compare them with more conservative bonds like government bonds. And even though we're seeing a decline here, folks are still favoring the more riskier bonds because they get a higher yield from that. We compare the S&P 500 to the 10-year Treasury yield, where we are chopping around a bit, but the S&P is outperforming the rise in interest rates. We look at the Fibonacci retracement levels for the 10-year. We're still well above all of these Fibonacci levels. Then we look at the 10-year Treasury yield, and Chris Shavako has been pointing this out in his weekly video, where for 40 years we saw a real downtrend of yields with lower highs and lower lows. Now we're starting to go back up a little bit with interest rates. Are we seeing a shift from something that we saw for a long time? Are we going to get into a new kind of normal where we see higher interest rates? We'll still have to wait to see how that plays out. Here's the 30-year yield with Fibonacci retracement levels. We're still above the 61.8% retracement. Look at junk bonds. These are still in an overall uptrend. When we compare junk bonds with corporate bonds, as it should be, the junk bonds are outperforming the more conservative government bonds. And then we look at the bond ETF, which really came under some pressure. Now it's been bouncing back up. The RSI is still above 50, but it is declining, but the MACD continues to be positive. Are we seeing a bit of a rebound in bonds? Then we look at a monthly chart with the 5-year yield. We're still above this longer-term moving average, but with the special K, which is a very long-term oscillator, it still shows that we're in a downtrend. With a shorter term, yet still kind of long oscillator, the KST, we're pretty much going sideways. Then we look at the 5-year yield with another study using the KST. In the short term, we're positive. In the intermediate term, we're flat. In the long term, we continue to decline. Then we look at a daily chart of yields, where yields had really been coming down this past week, but they did bounce back up on Friday. Then we look at a weekly chart of international rates, where the UK has the highest interest rates now, followed by the US and then Germany. Yes, Japan has very low interest rates. They have their own little story going on there. We're waiting to see if that's going to affect the U.S. market. Then we look at a price chart of bonds, which is different than looking at the yield chart of bonds, and we compare it to the CRB index, where bonds have been outperforming the CRB. Then we look at long-term bonds and do another KST study where we're crossing over positive in the short term, we're going negative in the intermediate term, but we're still positive in the long term. Then we look at the MOVE index, which measures the volatility of bonds, kind of like the VIX measures the volatility of stocks. As yields were really going down, we saw the MOVE index really decrease, as we're seeing the VIX really decreasing as stocks have been going up, and the correlation between the two is very strong. Then we look at some different sectors. Communications sector is in an uptrend compared to the S&P. Materials are in a downtrend compared to the S&P. The energy sector is also in a downtrend. Industrials are showing some improvement but are still in a downtrend compared to the S&P. Financials are really suffering and in a downtrend compared to the S&P. The tech sector is doing really well compared to the S&P. Staples are in a downtrend. Real estate is also in a downtrend. Utilities are in a downtrend. And we take a ratio between the S&P and utilities, and when this is going up, that often gives good support to the S&P. Then we look at healthcare, which is also in a downtrend. And here's another chart of healthcare showing how it's really been underperforming. Then we look at discretionary, which is showing a lot of improvement. We've seen a recent golden cross with this ratio. This is one of the more growth areas. Then we look at the staple sector. This is one of the more value areas where you get the things that you have to have. It's still in an uptrend, but it's been chopping sideways for a while now. We look at the tech sector, which is in a strong uptrend. We look at the semiconductors, which are also in a strong uptrend and could be coming back to threaten this all-time high. The tech sector to the S&P is really showing that tech is outperforming. Energy is really underperforming tech. And growth areas of the market are starting to really outperform bonds, which are not growth. We compare the two because some people like to adjust their portfolios based on what's happening. The tech sector is really outperforming the rise in interest rates, and then an inverse of that shows how interest rates are underperforming the rise in the tech sector. Discretionary versus staples. Discretionary had a recent golden cross and has been outperforming staples. Here's an inverse showing how staples are underperforming. Gold with the S&P. We're starting to get a death cross here with this ratio, meaning gold is underperforming the S&P. And it's also having a difficult time against the US dollar. We've been coming up to this downward sloping trend line. We haven't really been able to break through that with any conviction. Then we look at InterMarket Analysis going back to the beginning of 2023. Stocks are in the lead, followed by gold and then bonds. The dollar is actually now turned negative, and oil is also negative. We look at high leverage loans. These are risky loans. Would this ratio be going up as strong as it is if people that trade in the stock market are concerned that the economy is going to fall off a cliff? Probably not. Then we look at a ratio between small caps and the S&P. That's the red line, showing that small caps are really underperforming. The blue line is the S&P 500. In a really good, solid environment, we want to see the blue line and the red line both going up. The NYSE composite is in an uptrend. The Wilshire continues to be in an uptrend. All stocks are also in an uptrend. Emerging markets chopping sideways, but still in an uptrend. Bitcoin actually spiked up a little bit. Can't seem to get much above the 30,000 level now, but it is in an uptrend. Some correlations, and we're seeing some switches here. When we compare the S&P to the dollar index, they're having a real strong tendency to go in opposite directions. So if the dollar's down, stocks are up, and vice versa. We're also seeing that oil and the S&P 500 are having a tendency to go in the same direction. Then we look at S&P to the 10-year yield, where they had been going in the same direction. We saw it really drop off in this correlation. Now they're going in opposite directions. We also see that with the tech sector to the 10-year, opposite directions. And then one thing that was been a little frustrating lately is we use another indicator based on the 2-year yield. Well, the S&P and the 2-year yield had been going in the same direction. Now we're seeing a big reversal in that. Looking at some long-term secular and cyclical trend studies. Secular means decades, very long. Cyclical usually means a few years. We look at the NYSE composite chart, and this is monthly, where we're showing the Copic curve is turning back up. That's positive, and the NYSE is above the moving average. Another NYSE measurement looks at the high record percent index. This is also continuing to advance. We look at the S&P with the PPO. This is looking more positive. And then we compare the S&P to the CRB, showing that stocks are outperforming the CRB index. Then we look at the S&P 500 on a monthly basis and compare it with global indexes. It's above the moving average, so that's looking positive, but the KST is still measuring a downward trend. So what's positive for right now? And my definition of positive is when the 50-period moving average is above the 200-period moving average. The big software companies are positive. The euro and British pound against the dollar. Gold and silver continue to be positive. The mega caps, the low volatility ETF, the Dow Jones Composite Average, the FANG Index, as well as ARK. Bonds, all the different bonds that we look at continue to be in overall uptrends. Staples are still in an uptrend. Tech and semiconductors, high leverage loans, the Dow and mid caps, the NASDAQ and NASDAQ 100, the NYSE Composite, all stocks, emerging markets, and then we have Bitcoin. So our list is pretty long about what's positive. What's negative right now? This is when the 50-period simple moving average is below the 200-period simple moving average. The growth indexes that we looked at the very beginning, they are in overall downtrends, as are the value indexes. But when you compare growth to value, growth is outperforming. We have the CRB index, which is in a downtrend. Copper, we just saw a death cross with that on the daily chart. That's a new addition to this list. The dollar index is also in a decline. The Japanese yen is also in a downtrend compared to the US dollar. And then finally, we have the micro caps, really small stocks. And I have an asterisk here next to small caps because we have two indexes that we follow. The Russell 2000, which generated a recent golden cross. But when we look at the S&P small cap index, it has not generated a golden cross yet. Thank you. I hope you found this helpful. Please feel free to check out some of the other videos that I post. Have a great weekend, and I will talk to you in the next video.